Welcome back to the deep dive. It feels like every investor these days is chasing the same markets. Austin, Nashville, maybe Tampa.
Yeah, the headline grabbers.
Exactly. They're hot, they seem sexy, but boy, are they expensive. All that institutional money flooding in. It's really pushed prices way up and squeezed the cash flow right out.
And that's precisely why we're doing this today. It's kind of the core economic truth for buy and hold investors, isn't it? When everyone's greedy.
You got to be fearful, or at least cautious.
Right. You need to look for opportunity elsewhere. If you're chasing markets where cap rates are already compressed, you're basically just banking on appreciation, not reliable income. So we really need to shift focus, look at these smaller, stable, maybe tertiary markets, the ones with strong fundamentals that maybe aren't making headlines yet.
Okay, so our mission today, for you listening, is really to be your analytical shortcut. We're going to dive deep into one of these potentially overlooked markets, Fairlawn, Virginia.
Yeah.
It's in the greater Radford area. We're going to unpack the geography, look at the employment drivers, the stable ones, hopefully and crucially dissect the pricing. Does this place actually offer that stable, resilient cash flow potential that, long-term income investors are really looking for?
Let's find out.
Okay, let's unpack it then, starting with geography, connectivity. Because look, tenants need to get from their home to their job, right? Simply put. So where exactly is Fairlawn?
So Fairlawn, it's down in Southwest Virginia, kind of nestled in the New River Valley. It's basically Radford's next-door neighbor.
Okay.
But the really key thing for investment viability anyway is its location. It sits right on some major transportation lines.
And what are we talking about there? What lines?
We're talking Interstate 81.
Okay, that's a big one.
It is. This isn't some little back road. It's a major north-south artery, connects pretty much the whole East Coast. And US Route 11 runs right through the area, too.
Right.
So that connectivity, it's really paramount. It means the town isn't isolated. It actually links Fairlawn into a much bigger regional economy.
So that highway access gives people options for commuting. And what's interesting, looking at the source material, is how close it is to Blacksburg. Why is that important? It's about 15 minutes, right?
Yeah, about 15 minutes. And Blacksburg, well, that's home to Virginia Tech.
Huge university, research powerhouse.
Exactly. And while Fairlawn is pretty affordable, Blacksburg, less so. A lot of that is student density, lack of space, driving up costs.
Makes sense.
So having I-81 and those other routes nearby means people can actually live affordably in Fairlawn, maybe pay, say, $800 a month for a two-bed, but easily commute 15, 20 minutes to potentially higher-paying jobs, like staff roles at Virginia Tech or maybe jobs in the research parks around there.
Okay, so buying in Fairlawn isn't just betting on the local Radford economy. You're actually tapping into that whole new River Valley employment base.
It's it.
That feels like a pretty significant de-risker right off the bat.
Definitely.
So we know where it is. We know people can get around, but, nobody moves somewhere just for the highway access. They need a job. So let's shift to what's really driving demand, employment. And we absolutely need to avoid that one company town risk. So what are the stable pillars holding this place up?
Yeah, stability here seems to come from some pretty essential, almost non-cyclical sectors. First pillar is education. That's anchored by Radford University. Public university, over 9,000 students.
Okay, Radford University. But if that's the main anchor, isn't that kind of risky? I mean, what if enrollment dips or tuition changes drastically? Couldn't that hurt the whole town? How diverse is the actual university employment?
That's a fair challenge. And the answer, I think, is in the type of employment. The university employs hundreds of people.
Yeah.
Faculty, sure, but also administrators, maintenance staff, support roles.
Right, the whole infrastructure.
The whole infrastructure. These are generally year-round jobs, salaried positions, people who need stable, long-term housing, and crucially, public universities like Radford, they don't just pick up and move.
Good point. They're pretty rooted.
They are. They're about as stable an economic foundation as you can get, generating pretty consistent housing demand year after year.
Okay, that makes sense. So education's pillar one. What's number two? Healthcare.
Correct. You've got the Carillion New River Valley Medical Center right there.
Major regional hospital.
Yep. And healthcare. Well, that's about as recession-resistant as it gets. You can't outsource hospital care.
True.
And it provides stable, generally well-paid tenants. Think nurses, technicians, specialized staff. They need good, clean housing near work. A hospital anchor like that is probably one of the best buffers any investment market can have against, economic bumps.
Education, healthcare. Those are solid stabilizers. Yeah. But the third pillar you mentioned is advanced manufacturing and technology. Now, when I hear manufacturing, in a small Virginia town, I admit I sometimes picture an old, maybe dying industry, like textiles or something. What are we really talking about here?
Yeah, we need to ditch that old mental image. This isn't your grandfather's manufacturing. It's high-skill, advanced tech, often with pretty deep government or industry connections. Okay. The sources specifically mention companies like ADVA Corporation. They do fiber optic networking gear. That's a growth sector, obviously, essential for, well, everything digital now.
So clean, high-tech jobs,
Mm,
not smokestacks.
exactly. Then there's Cole Morgan. They do industrial automation. And Moog, which makes aerospace and defense components. Moog, especially, often works on really stable, long-term defense contracts.
So government stability, too.
Potentially, yes. So that mix, you've got education, essential medicine, and this advanced tech shop, it creates a base of skilled workers earning decent wages, maybe $35,000 up to $60,000, maybe more. And they all need somewhere to live.
Right.
That diversity, that blend, it spreads the risk for an investor quite nicely.
Okay, let's pivot now. Let's talk affordability, because this seems to be where the market really shows its strength, that financial buffer. How do the rents here compare to those hotter markets we started with?
Yeah, the data shows a really significant gap. I mean, current rents for maybe an older one-bedroom might be around $570, $575, but a renovated one, closer to $700. And two bedrooms, which are often the sweet spot, right? For working couples, small families, they seem to be mostly in that $750 to $850 range, maybe topping out around $899, $900.
Okay, so let's put that into perspective for you listening. If you're looking in Northern Virginia, near D.C., you're easily paying $2,000, maybe more, for a decent two-bedroom.
Wow, easily.
Even somewhere like Richmond, you're probably pushing $1,200 plus. So Fairlawn's offering that same space for potentially half the cost. But how does that translate into stability? Let's talk about the wage-to-rent ratio there.
This ratio, this is kind of the secret sauce, I think, for lower risk investing.
Okay.
If we use that standard rule of thumb, rent shouldn't be more than, say, 30% of your gross income.
Right.
Well, a $750 monthly rent only requires a household income of about $30,000 a year.
$30,000.
Yeah.
And we just established the jobs there. University staff, hospital techs, manufacturing workers, they're often earning well above that.
Yeah.
$35K, $40K, $50K, $60K plus.
Exactly. So for most of the target tenant base, rent isn't this huge financial burden. It's an easy necessity purchase.
Not a stretch every month.
Precisely. And that financial buffer, that's your protection when the economy gets shaky. If there's a minor downturn, a tenant who's only spending maybe 15% or 20% of their income on housing is way less likely to default or move out compared to someone in a big city paying 40% or more. That translates directly to lower vacancy risk, much more stable occupancy for you as the investor.
Okay, but if it's such a good deal, stable jobs, cheap housing, why aren't the big developers rushing in? You know, building those huge 400-unit luxury complexes. Why is the new supply apparently limited?
It really comes down to scale and what they call the absorption rate.
Absorption rate, meaning how quickly units get filled.
Exactly. These large institutional developers, they're working with massive amounts of money, debt, equity partners. They need to build big, like 300, 400 units at a time. And their financial models demand that those units get filled, usually within maybe 18 months or so.
Right. They need quick returns on huge investments.
Yeah. And the Radford Fairlawn market, while it's stable, it's probably too small to absorb 300 or 400 brand new high-rent apartments that quickly.
So the risk of having too many empty units for too long is just too high for the big guys.
That seems to be the case. And that risk for them, it translates directly into less competition for owners of the existing properties, the ones that are already there, already cash flowing. Because the big developers tend to skip over these smaller tertiary markets. The existing housing stock, which is exactly what a buy and hold investor is usually targeting, stays relatively insulated from a flood of new high-end competition that could push rents down.
Less competition is definitely a plus. But we need some proof that the market actually works, that properties trade at these prices. Let's look at the comparable sales data from the sources. What are things actually selling for per unit?
Yeah, this is where you see that pricing hasn't fully caught up to the fundamentals yet. There are several recent sales that kind of confirm things are moving. For instance, there was a 6-unit property, older build, 1955, I think, sold recently for about $87,000 per unit.
Wow, $87K a door.
Yeah. Then a more mid-range place, a 4-unit from the 1970s, that went for $153,000 per unit.
Okay. Quite a jump.
And then a newer one built in 2006, also 6 units, that sold for about $216, maybe $217,000 per unit.
So looking at that range, roughly $87,000 up to maybe $217,000 per door. If you compare that to, say, 250K, 300K, even 350Ks per unit you might see in secondary markets nearby, let alone the big primary cities.
Yeah, the gap is obvious.
It really confirms that pricing difference. The big money is chasing deals elsewhere, which leaves room here for potentially solid cap rates.
Absolutely. I mean, think about it. If you can buy a property here at, say, $150,000 per door, and you're collecting $750, maybe $800 in rent, your cash flow potential is just going to be significantly better than buying that exact same rent stream in, I don't know, Nashville for $300,000 a door.
Right.
That lower cost basis here, that's really the foundation for potentially high cash-on-cash returns.
Okay, finally, we have to touch on risk and the long-term picture. The number one concern people always raise about investing in smaller markets is liquidity.
Right.
If I need to sell this thing in 5 years, is anyone actually going to buy it?
It's a totally legitimate concern. And we have to be honest, liquidity is definitely lower here than in, say, Austin or D.C. You're probably not going to sell a property in 30 days, maybe 90 days, maybe 120.
Okay.
But remember those sales we just mentioned? 3 recent transactions right there. Properties are trading. It just reframes the whole approach. You're not buying this type of property for quick, short-term liquidity.
They're buying it for the cash flow.
You're buying for the cash flow, probably on a 10-year plus hold strategy. That's the mindset.
Okay, but what about a major recession? If things really hit the fan economically, how does this specific employment base at the university, the hospital, the defense-related manufacturing, how does that hold up compared to maybe a high-flying tech hub that might see big layoffs?
I'd argue it's exponentially more resilient.
Really, why?
Well, think about it. Major universities, regional hospitals, they generally don't just close during a downturn. Their funding, while maybe stressed, tends to be more stable. Defense contracts are often long-term commitments.
Okay.
And crucially, remember that necessity rent factor we talked about?
Yeah, the affordability.
Right. In a real economic crunch, people might have to trade down from luxury apartments in expensive cities. But they're much less likely to leave affordable housing in a market like Fairlawn, where rent is already a small percentage of their income. That really helps shield you, the owner, from huge vacancy spikes.
That makes sense. You know, thinking about retention, the sources also brought up the lifestyle factor, which honestly surprised me a bit as an investment point, the whole new River Valley outdoor recreation thing.
Yeah, don't underestimate that. It's actually a massive factor indirectly because it helps reduce your operating costs as an investor.
No, so?
Because the new River Valley, the Blue Ridge Mountains, they offer fantastic outdoor stuff. Hiking, kayaking, biking. For a certain type of professional, maybe younger staff, tech workers who prioritize quality of life and lower costs over just maximizing salary, this area is really appealing.
So they stay longer.
Exactly. Better quality of life often translates directly into better tenant retention, and that means lower turnover costs for you, less painting, less cleaning, fewer vacant months between tenants. It adds up.
That's a great point. And what about those sort of hidden risks that seem to be growing in bigger cities,
Right.
like increasing regulation?
That's another maybe underappreciated benefit of playing in these tertiary markets. Big metros, think New York, California, even places closer like Richmond, now they're increasingly dealing with more regulatory risk. Rent control talks, complex eviction rules, new tenant protection laws. It can make owning property more difficult and unpredictable. Smaller, stable markets like Fairlawn, they typically face far fewer of those regulatory hurdles. It just offers a cleaner, generally more predictable environment for a long-term investor.
Okay, so let's recap this for you, the listener. What have we found here in Fairlawn Radford? We've got stable jobs driven by pretty non-cyclical employers like a university and a hospital.
Check.
We've got major highway access connecting it to the wider region.
Check.
Incredible affordability backed up by that wage-to-rent ratio.
Yeah, that's key.
Limited competition from big developers building new supply.
Right.
And actual verified sales data showing properties are trading, but at prices that still seem reasonable compared to hotter markets. So yeah, maybe it's not the sexiest market out there, but it seems built on pretty boring, stable fundamentals.
And boring can be beautiful in investing. This is really the textbook definition of a contrarian play, isn't it?
Looking where others aren't.
Exactly.
Yeah.
We're looking for solid cash-on-cash returns here, not gambling on massive appreciation. And honestly, some long-term trends might even favor these types of markets.
Like,
Well, healthcare demand is only growing nationwide. Affordability is becoming a huge priority, especially with remote work allowing people more location flexibility. And like we said, these smaller markets often just stay out of the crosshairs of the big institutional money and the heavy regulations.
so this is really the right fit for that specific type of investor. The one focused on cash flow, stability, resilience.
Not the short-term flipper looking for a quick buck.
Right, not the appreciation hunter.
Absolutely. And now that we've kind of established that the market itself seems to make a lot of sense logically, well, the next step is to put this theory to the test,
I
right?
figured it works in practice.
So next time we're going to dive into a specific hypothetical deal right in this market. We found a listing, Fairlawn Apartments. It's a 17-unit portfolio priced at $875,000.
Okay.
We'll break down the unit mix, look at the rents they're getting versus what the market might support that potential rent gap, and actually try to calculate the real cash flow potential. See if a specific deal can actually live up to the market opportunity we've just explored.
All right. Looking forward to digging into the numbers on that one. Make sure you join us next time for that deep dive.